Bismillahirrahmanirrahim. Assalamu alaikum. My dear students, the next part of the valuation of the long-term securities, specifically common stock. In previous video, we focused on the discounted cash flows method, while the second method of the valuation is the relative valuation techniques. In a previous video, we discussed the discounted cash flows. If you are interested, you may visit it. And in this video, we are only going to focus on the relative valuation techniques. My dear, in relative valuation techniques, the value can be determined by comparing two similar stocks based on a relative ratios. The relative ratios are like price to earning ratio, means the earning per share. There is the price to cash flow ratio. We focused on the cash flow, book value, and sales. I have bold the word similar stocks, which I will explain later on, and we will also explain one by one this each relevant variable included: earning per share, cash flows, book value, and sales. The most popular relative valuation technique is based on the price to earning ratio. But first, let me explain it that why we are going to consider the similar stocks. Why not we consider a single stocks for the valuation of a single firm? Like for example, if you see this is the example of the formula of the price to earning ratio. Price to earning ratio. My dear, if on a single day the market price of the share increase or decrease dramatically because of some event, it will then misguide us, because our acceptance or our undervalue overvalue decision criteria is based on the market price of the share of a single security. So it could happen that a single security on a same day, on a given day, increase or decrease because of some event. So that is why we will not consider a single firm while making the valuation of a common stock of any given security, but we will create a peer group. Like we can say we will consider same industry. So then we will take the average of the industry. Now these concepts we will continue in the next slides. But how to create these peer groups? How to create such firms that could give us an average price to earning ratio or any other related ratios as already discussed, like price to sale, price to earning ratio, price to book value. So we should consider a group of the firms that are up to large extent similar, which will help us to present a single firm that is a part of the similar firms. Now for example, you can see that these are the two houses. One house is located in Islamabad, and one is located in a small village in Pakistan, that is Hangu. So you can see that the house size of both are same, but still if you check out the value of these houses, the value is not same. Why? The reason is that one is located in capital city of the Pakistan, another one is located in our village. So we cannot bring such kind of the assets in a one group and then value this house in Islamabad or this house in Hangu. We need to consider such a group where the number of firms are closely similar. Like for example, now you can see if in this example, if we assume that both of the houses are in Islamabad, in the capital city of the Pakistan, still we cannot compare it. Now the geographical position of the both houses is same, but size also matter. So this house is a small in size while this is a big house, so the price of the big house will of course greater than the small house. So we need to create a peer group. The criteria for the peer forms is geographically, and there should be a same sector, because the different sectors have different risk profile and different financial even different financial assets and balance sheet. For example, if you compare financial firms with the non-financial firms, you will see that the fixed assets in non-financial firms are greater than the fixed assets of the financial firm. So we should consider a similar sector, and then we should consider a close size, a similar size. If it is not possible, so the size of the firm should be similar or even close it. The criteria, the proxy to measure the size of the firm is one of the criteria is the market capitalization. Market capitalization equal to outstanding shares multiplied by market price of the share. So if you are going to use the relative technique, and you are going to select the number of the firms to take their average and then value the worth of a single security of this given group, one criteria to measure the size is the market capitalization. So another criteria, famous criteria, is enterprise value. There are criticism on the market capitalization, because if the market price of the share shoot upward or downward on a single day, it will of course shoot upward or downward market capitalization also. So the another criteria, famous criteria, is enterprise value. By enterprise value, it means the total capital that is invested in business. To make it easy for you, like for example, if there's a company, it is financed through, for example, two sources. One is equity and one is debt. In asset, for example, if we have an asset of machinery like another, for example, land, and we have another variable like cash. Now if you see, these are the assets where we have invested amount, and these are generating a fund for a firm, while this cash is not yet invested, the ideal amount which we are holding. So by invested capital, in similar word, we means that the assets that are the amount, the cash that is invested in the capital and which is helping out in the operation of the business. So the ideal amount, for example, cash, which is not, although it is important, every asset is important, but it is not yet invested. So if you want to calculate the intrinsic value, the enterprise value, so you can see the formula from here. It includes the equity value, the market value of the debt. If you have finance from the preferred shares, the market value of preferred share, the market value of minority interest, minus we are deducting the cash and cash equivalent, and similarly we are deducting the market value of non-operating assets. So enterprise value consider only those assets which only those capital which is invested in the business. So this is the criteria to select similar firms. Now let's start the calculations. The first ratio is the earning multiplier model, or we also call it the price to earning ratio. There are different methods you use, but I will try to make it very much simple. The price to earning ratio formula is the current market price of the share divided by earning per share. Now earning per share depend on the net income of the business, while current market price of share, it depend on the current market price of the share. Like we can see that here, the formula of the earning per share is net income divided by outstanding shares. Market price share ratio is the market value of equity divided by outstanding shares. The book value per share is book value of equity, means the value of the equity given in a balance sheet divided by outstanding shares. This ratio, although it is at the moment irrelevant, but it will be used in further slides. So my dear, this is the example. For example, you have selected these four firms according to the peer group, the criteria we have earlier discussed. So you have selected the four firms. The market price of the one firm is 40, and its earning per share is 20. Now the earning per share shows the actual worth. Like if you see that if I calculate the price to earning ratio, it shows that your market price of the share is 2 times greater than what you are really earning. So the people are paying more price. Your earning per share is 20, while people are paying, your per share earning is 20, while people are paying you 40 rupees. So it means it is 2 times high. Individually even you can see that it is overvalued. Similarly, if you compare the second firm which market price is 20 while its earning per share is 15, so it is again 1.34 times greater. So your share is overvalued in the market. In last 2 cases you see that your earning per share is 50 while people are paying you less than the 50, that is 30. It means the market price of the share is undervalued in the market. Similarly in the 4th case. So my dear, how to calculate the intrinsic value. The very first step is to calculate the average price to earning ratio of the given firms. First we calculate the price to earning ratio. How? Market price of the share divided by earning per share. The formula is already discussed in previous slide. So then we take the average, summation x by n. So the average price to earning ratio of these 4 firms or a peer group is 1.162. Once you have calculated this, now you are supposed to find out the intrinsic value. Intrinsic value means the worth of the share while using the price to earning ratio method. The intrinsic value is that you are supposed to calculate the earning per share of each firm multiplied by the average price to earning ratio. So this is the earning per share, 20 multiplied by 1.162, 15 multiplied by 1.162. Now you can see that in this case also that the intrinsic value, the worth of the first firm is 23 while the market price of the share is 40. So you can see that it is overvalued in the market. Individually it also shows, but we are going to take the average because on a single day the firm price could shoot upward or downward on a single day. That is why we are considering the average price to earning ratio instead of the single price to earning ratio of a firm. So my dear, you can see that here the earning per share is 50 multiplied by 1.162, the answer is 58. Now you can see that the worth of the share is 58 while the market price of the share is 30. So this particular share is undervalued in the market. Like for example, I have created a formula. Like for example, you can see that if the price of this firm is 40 and earning per share is, let's suppose, 60. If the earning per share is 60 and market price of the share is 40, it means that it is undervalued. You can see that when the earning per share is more than the market price of the share, it means that it is undervalued, and also the average method shows that it is undervalued. So you can see the intrinsic the average formula first. Let me undo it to make it similar to your slides. Now you need to take the average. Once you have took the average, then you are supposed to multiply average price to earning share with the given earning per share of each firm. You can see. So this is how you calculate the intrinsic value of the worth of the share. So the criteria for calculations are similar to the other ratios. Also, you can use the same concept in other ratios. Now, my dear, there is criticism on the price to earning ratio. The criticism is that price to earning ratio is based on the earning per share. For example, like if I took the example of the this is the sales cost of goods sold equal to gross profit, and then you deduct the operating expense, it results in the EBIT, and then you deduct the interest, it then results in the earning before tax, and you deduct the tax, and then it results in the net income. Now, my dear, in case of sales we have two kind of sales. Like for example, One is based on the cash and another is based on the credit. So in income statement you consider all the cash, all the sales, whether that is because of the cash or that is because of the credit. We can manipulate easily the net income inside the rules even. For example, if we take the example of the consignment revenue, this by consignment revenue means we sales item today and then receive its cash in the future. For example, if I make an agreement that in November I make an agreement of the sales, that for example I'm going to sell the 50,000 rupees item, and then I will receive this 50,000 in the February. This is the consignment revenue example, in where we sales a product today and receives its cash in the upcoming days. Now in this case, my dear, according to the accounting principles, I can realize this 50,000 on the day when the transactions has been occurred. Although I didn't receive this 50,000, I am going to receive this 50,000 in the next year. If the closing year is December, so I am going to receive, for example, this is the December 2022, so I am going to receive this amount in February 2023. But according to the accounting principle, I can realize this 50,000 in this year in 2022, because this event is occurred on November 22, 2022. So I could realize this sales. While this 50,000 is going to be added in the income statement, and it will increase the net income also. And when I calculate the earning per share, I use this net income amount and then divided by the outstanding shares. Now if this net income is high because of this 50,000 which is not yet received, so automatically the earning per share will be also high. So that is why there is criticism that the companies can manipulate earning, like I have given the example of the consignment revenue. So that is why some of the guys are in the favor of using the cash flows per share instead of the earning per share. So cash flow is less prone to manipulation. The concept is same. Cash flow is important for fundamental valuation and especially in a credit analysis, as I give the example in Excel. The formula is same. Like in this case, we can see that in the price to earning ratio, it was the price market price per share divided by earning per share. In this case, we are supposed to divide the price divided by the cash flows per share. We will find out the net cash flow and then divide it by the outstanding share. Further, the concept is same. Like I have again given an example, but this time you can see that the cash flows per share is less than the here. If you see, let me show you in MS Excel. It will be more easy for you. Like you can see that the price earning per share was 20 for the first firm, while here the cash flow per share is 15. Here you can see that the earning per share is 15, while here the cash flow per share is 11. Why it is mostly it is less than the earning per share? Because in earning per share we include both the credit sale and the cash sale, while cash flow, when we calculate cash flow, we don't consider the non-cash expense and non-cash revenue. So that is why the cash flow per share most of the time is less than the earning per share. So my dear, again the concept is same. You first calculate the cash flow per share. The formula for this is market price of the share divided by cash flow per share. Again my dear, you can see that the cash available for a one share is 15. Now the market price is 40. It is overvalued. And similarly, if you use the criteria of the average, the intrinsic value or the average method, you take the average of this cash flow per share, which is equal to 1.54, and then to calculate the intrinsic value, you are supposed to calculate the cash flow per share of the given firm, multiply it with the average price of the cash flows per share. So you can see from here also the worth of the share is the 23 while it is available in market 40, so it is overvalued. Similarly, again you can see that if the intrinsic value is less than the market price of the share, we say that it is the overvalued, and vice versa. So my dear, similarly you can use another relative ratio, that is the book value per share. It is widely used to measure the bank value. Bank assets are liquid bonds, and this, like I will give you example. For example, if you see that the book value of the share is 30, by 30 it means that the book value of equity given in the balance sheet. So if this is, for example, it is 50,000. Let me make it like this, easy. The outstanding shares is, for example, 1,000. So then the book value per share is 50,000 divided by outstanding share, it is 50. This is book value of the share is 50. In case of insolvency, if it is declared insolvent, so the claim of the single shareholder according to the balance sheet is 50. Now if the value is, if the market price of the share on the same day is 60, it means that your default risk is low. If I liquidate these assets in the market and the shares in the market, I will receive 60 rupees for each share. So here the default risk is low. Vice versa, if the market price of the share is supposed on the same day 30. Now in case of insolvency, your per share claim, it's according to the balance sheet is 50, while if I liquidate we will receive a 30 rupees for each share. So here your default risk is high. So book value per share is also very important determinant. We used to find out, we use this in this formula to examine whether the asset is overvalued or it is undervalued. Like for example, in this case you can see that the book value per share is 30, while in market people are paying 40 rupees for it, so it is overvalued in the market. But I'm repeating it, I'm not using the criteria of undervalue overvalue by using a single firm, because as I told you, on a single day the price could up and down because of any reason. That is why I am taking an average. For this purpose I consider a peer group of the firms. Therefore there was criteria of their geographical position, their size, and the third one was the size, geographical, and the same industry. So the more similar you consider the firms, the more accurate average you will receive to calculate the intrinsic value. So my dear, further the criteria for the intrinsic value is again same. You can see in this slide, now the price of the book value per share is 30. Now you can see that it is already, it shows that it is overvalued. So, and if you use the average method by taking the average of this all four firms book value per share, and then if you are interested in calculating the worth, how you can calculate it, you are supposed to multiply book value per share with the average book value per share ratio. In this way you can calculate the intrinsic value, and you can check the status whether it is overvalued or it is undervalued. And for example, if I increase this price, no, the book value per share is 50 while the market price of the share is 40, so it shows that it is undervalued. Individually you can also see, and on average also it shows that it is undervalued. So my dear, hopefully you are getting my point how to calculate the intrinsic value. Now my dear, similar method could be used. You can consider the price to sales ratio. I'm not going to repeat the this formula again and again. Strong consistent growth rate is a requirement for a growth company. sales are subject to less manipulation than other financial data. Like for example, if you check out the cost of goods sold, if you check out the depreciation, that you can play with them. We can manipulate those values. We have different methods of depreciation, and we have like we can use a Macker, we can use a straight line method, and many other methods. So sales is considered a less, although it could be manipulated, but it is considered a less. So that is why here we use the price to sale ratio. The concept is similar. If the formula is the market price of the share, so this is the formula, market price of the share divided by sales per share. Further, I didn't calculate it because I think it will bore you. It is repeating again and again. Hopefully you got it. If you have any question, please comment, and you can even email me. Thank you.